Hello and welcome to this MithrilMoney Securities Investment 101 course. This is lecture 9 on credit ratings. Now in the last lecture, if you remember or you want to go back quickly to revisit it, though you don't need to, we had somebody who was buying 3 what looked like identical bonds. They were all a maturity of 10 years. They were all face value of $100 and they all had a coupon, a fixed income coupon, the fixed amount of money coming back each year of 10%, and they were all annual bonds. The thing is though, they all had different issuers. So one issuer was AAA rated, one issuer was BB rated, and one issuer was C rated. And what that meant is even though the bonds were identical except for these ratings here, they had different prices. So this one was what's called a premium bond, and somebody paid $105 for that one. Somebody paid $100 for this bond, which is known as a par bond. So when you pay the same price as the face value, it's a par bond. And somebody was prepared to pay $85 for this one down here, which was the C-rated organization, and that's known as a discount bond. So why are they paying 3 different prices for 3 bonds which have the exact same features, just because the rating is different? Surely if you're going to be paid for 10 years, you're going to be paid for 10 years. Though, of course, what will happen is some organizations have a much greater risk. At risk of what? A risk of not paying you. So if we look at a timeline, let's say we've got our lady here. So we've got Lady Penelope here. And Lady Penelope has bought this 10-year bond. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And she's getting the $10 each year from this particular bond. And then in the last year, she's getting that $10 plus the $100 face value. What she's afraid of is a risk of the company going bust or having difficulties before then. I think she bought a bond in the MithrilMoney fish sauce company. Is going bust before the end of the 10 years, and let's say going bust there, she's not going to get any of these payments. Now there always is a risk of not getting those payments, so she, at that point there, is going to be extremely sad. So she's got a bit of a smiley face there, so we'll replace that with a bit of a sad face there. So she's got basically a worthless piece of paper. Well, pretty worthless. We'll talk about how it's not entirely worthless later on, but it's definitely not worth what it once was the day before. Okay, so the risk of going bust is much higher in kind of new companies, in volatile companies, in new technology companies, and it's less in well-established companies with lots of assets which they can use to hopefully pay off these things. Now, the lowest risk of all will generally be a government which issues a currency. So if we take the UK, let's say, so here's the UK, and the UK government based in London sells a pound bond. Well, that's going to have the lowest risk for any pound bond because the British government can print pounds. If it really, absolutely desperately has to, we can go to the Bank of England and ask the Bank of England very nicely to print lots of pounds to buy the British government bonds. So basically it can print money at will. Now, if I was to do that, so I live kind of here, then I go to jail for counterfeiting. When the British government prints pounds, it's called managing the money supply. So lowest risk of all will typically be a government issuing currency bonds in its own currency that it's allowed to print. So they will typically get a very high rating of something like AAA. A company I might start, I don't know, some kind of tourist agency type thing, would have a low rating, maybe a B rating, maybe even lower C rating, because I haven't got a definite cash flow and I'm much more likely than the British government to run out of money in the next kind of 7 years' time. So that's why on the previous slide we'll be paying different prices for these bonds dependent upon the ratings that the MithrilMoney ratings agency was supplying to us. So what do you do to get hold of one of these ratings here? Well, you can either work them out yourself. You can have a kind of credit risk analytics department which can work out the credit risk of each of these organizations and provide you with a table, or more likely you'll go to hopefully an expert group in another company and this is the MithrilMoney ratings agency. Now, you can pay them for the ratings, and then they will give you independent ratings, and they will use lots of clever people to work out the chances of individual organizations failing, or you can kind of download them off a website, but then there's no such thing as a free lunch, is there? So you've got to be sometimes careful with ratings which are just provided freely. Somebody paid for them somewhere. Some ratings agencies will have the bond issuers and paying them to rate their bonds and to rate the companies. So perhaps potentially there might be a conflict of interest. That's for you to think about and decide upon. But I like the MithrilMoney ratings agency here because I know that they're independent and they're giving me their best assessment, and there's absolutely no conflict of interest. Now, sometimes you will hear that the company is rated one way. Let's say the company is rated AAA, and sometimes a bond has an AA rating coming from a company which is rated AAA. Is that possible? Of course it's possible, because we have to go back to a kind of an earlier lecture, which I'll just summarize here. In liquidation rankings, worrying about companies going bust or not, there might be, the MithrilMoney tourist agency. That might be an AAA rated organization. And if you say, what's the rating of the company? It's AAA. But remember, as we go down liquidity rankings, we go from senior to junior, or it's saying the same thing as going from least risky to most risky. And so individual issues of debt products coming out of an organization might get separate ratings from the corporation. So a secured debt, which is secured upon the company's property, and it's got more property than the bond is worth, that might get an AA rating or even an AAA rating, but we'll just give it AA. Unsecured debt, which is just a promise to pay and is not based upon any assets that you can grab hold of after a bankruptcy, might be rated A. And subordinated, which is even junior to unsecured debt, might be rated BB, which is even lower still. Now, underneath all creditors, we have this kind of quasi-debt instrument type thing. It's a kind of mixture between equity and debt, and that's the preferred shares that we talked about earlier in the course, because it's got this dual nature. They'll be rated as well. Now, they'll be subservient and junior to all creditors, and that might be, say, CCC rated. So it will be in there, it will be rated. It's a sort of a debt instrument with a coupon, but it's called a fixed dividend rate instead of being called a coupon rate. But logically it's the same thing, but it will be the most junior of all. Okay, so both companies and their debt issue products will be rated by the credit ratings agencies. Now, they'll typically divide everything into two particular kind of universes. In universe one, with high liquidity, it's very desirable stuff, and this will be the kind of thing pension fund managers are allowed to buy, and the kind of things people who like safety will be buying, is what's called investment grade. So, if I can spell it. Now, that's the kind of most liquid stuff. It's also the most senior stuff. It's kind of the least risky stuff. Now, underneath there, into the kind of danger territory, we have what used to be called in the 1980s, what used to be called junk bonds. So if you watch the Wall Street film, the first one, the good one, and that'll be called junk bonds, but we don't want to call it junk bonds because you don't want to go to a party in Mayfair and say to somebody who's looking at you across the room, oh yes, I sell junk bonds for a living. What you want to say is you say, I sell high yield bonds for a living. It's much kind of better thing to say at parties in Mayfair. So we have investment grade bonds and we have high yield bonds. Now the magic boundary, we'll talk about in a second, but in detail, but just quickly, we'll just put the boundary here. The boundary here is BBB minus to BB plus. That's the kind of magic cliff. And you think of this as being the White Cliffs of Dover here. The White Cliffs of Dover, that's where we fall off the White Cliffs. And we fall into a raging torrent. So we've got the kind of the green cliffs of Dover at the top here. And then we've got the cliffs. And then we fall into a sea of despond down the bottom there. So then we fall into this crazy washing sea filled with waves and all sorts of horrible things, just like the Harry Potter film. Okay, where we go to Voldemort's cave. So what do you want to buy? Do you want to go for a nice ride? A nice high yield ride, or do you want something that you can sleep safe and sound with? It's up to you. Let's get into a bit more detail then on the different grades. So we'll start with the highest grade. This will typically be governments or ExxonMobil or extremely large companies with lots of assets which they can call upon in case of a default. So AAA will be the highest rating of all, and this will have a name which will be something like Prime. So a Formula One racing driver would call this an AAA tyre, would be a Prime tyre. We then have underneath that, now some ratings agencies don't follow this kind of Brave New World alpha, beta, gamma system, but I can never follow those ratings. I mean, they're usually completely unintuitive. Most of the ratings agencies use intuitive rating scales like this one, though it will vary in your part of the world perhaps. It all depends on the area, the market, whether it's a commodity rating system, whether it's a commercial paper rating system or whatever. But this is the general bond rating system that most ratings agencies will pretty much stick to most of the time because most people understand it fairly intuitively. Now underneath there we'll have AA. Now these will typically be broken down into AA plus, AA and AA minus. Now, I haven't got room on the slide to do all of them, but apart from AA and possibly C and D, most of the kind of ratings will be broken down into this plus, neutral and minus kind of area. So, but I'll just get rid of that now and assume that you remember that for the rest of this slide. The AA itself will have a name, it might be something like high grade. Not the highest grade, notice, not prime, it's high grade, not the highest grade. Then we'll have A, and this will be kind of upper medium grade. So upper, I'll just put med for medium. Then we'll get down to the lowest investment grade, BBB, and that will be lower medium. At this point, lots of pension fund managers will be getting nervous because they have to sell if it drops lower than that. So that's why we have that kind of White Cliffs of Dover effect. Now I just need to shuffle these up so I can get the rest of them on the slide. So I'll just shuffle this up the page a bit. And we'll just squash these up a bit. There we are, move them up. There we are. Now we drop down the chasm. So we drop down the chasm, the cliffs, and we go to BB grade. Remember, the first of the junk bonds. So, like the last of the Mohicans, this is the first of the junk bonds. Sorry, caught myself saying that again, haven't I? High yield. High yield. Remember, these top ones were investment grade. So that's why pension fund managers like them, so that they can say we stick to only investment grade products. These ratings can change on a regular basis. And sometimes a ratings agency will say, we're warning you, we might have to degrade this in 3 months' time. And sometimes they just go ahead and do it. And they drop something from a BBB to a BB, or from a BBB minus to a BB plus, which isn't that much of a drop. But it's like saying, if you're standing on the White Cliffs of Dover at the top, stepping forward 1 foot isn't much of a progression forward, but it's a huge drop down. Then we'll move down to B rated. This will have a name of highly speculative. Oh, I missed out a name for BB, didn't I? Highly speculative. A BB will typically be called something like speculative. So from the Latin to gamble. Speculato. Speculative is, you're gambling a little bit here. You're going for high kind of returns and you're balancing it against higher risk of default. Now, once we're down to B, now we're kind of getting into hairy territory. CCC will be next. That will be labelled something like substantial risk. So substantial risk. We're getting a bit crazy now. Now we're getting down to some kind of nasty areas. CC. Now, who knows what that's going to be called in your local language. I'm just going to call this hugely horrible. So hugely horrible. Then we get down to the kind of, this is the last of the Mohicans. C, I'm going to label this nasty, nasty, nasty. Nasty, nasty, nasty. You know, very, very hairy down here. Kind of pulling your hair out on these ones. And then, unfortunately, we do have D. And D stands for what it kind of says on the tin. It stands for default. It has defaulted. A coupon wasn't paid on time. We'll talk about what that means when we talk about credit default swaps much later in the course. D, by the way, doesn't necessarily mean you've completely lost all value in the piece of paper. Our friend here might have been holding a D-rated bond, which had a face value of $100. Going from C to D doesn't necessarily mean that that thing's completely worthless. Remember, we'll now be able to sue the company and take them to the bankruptcy court as a creditor. And when we do that, the judge will be awarding us the assets of the company to recompense us for our loss in this security. Remember, that's why it's called a security. We have some kind of security in the company. And we might get, it all depends on the circumstances, but I'm going to say approximately $40. So you could sell that piece of paper on for $40, maybe sell it to somebody who likes asset stripping companies, and they'll go to the company and they'll strip the assets out of it and maybe sell off $45 worth of assets to recompense themselves. So they'll make $5. Now turn that from 40 million into 45 million, and we're talking $5 million and profit for the asset stripping company. But in the free market, we need creative destructionism, and that's what's going on in the default zone down here. So lots of Joseph Schumpeter fans, Ludwig von Mises fans, and creative destruction fans are living in a kind of default zone. So what does AAA mean in the real world then? Well, imagine that a company has issued a whole series of bonds, and somehow bizarrely they can issue bonds with all these different ratings. Well, this would be the most senior. This hairy fellow down here would be the most junior. Let's look at the, I'm just making these numbers up, but let's look at the kind of percentages of returns that you might get from these particular things. So this one might be paying 2%, fixed coupon, you know, $2 a year. This one might be paying 3%. This one might be paying 4%, and so on, and so on. So as we go down, there'll be a big jump here. 8%, 9%, 15%, 25%, 30%. And, well, it's not paying anything, but it, you know, just before it collapsed, it was yielding just over 30%. As we go down here, remember Jensen's inequality, as risk goes up, then reward. And prices of these bonds, you know, this might be 110, this might be 109, 108, 107. So this might be 95, 85, 75, 70, 50. And then we're down to the default ones, and that'll be worth approximately, depending on the market you're in, say about 40% of the face value. Now, a further question is, what does AAA mean then? So the MithrilMoney Ratings Agency company has given us all these ratings. What does it actually mean? Is it just an opinion? Is it like saying, I think she's an A candidate for the role? I mean, what does that mean? It means she's probably got the job, but we need something a bit more quantitative. What the rating will mean is something that looks a little bit like this to most ratings agencies. What AAA might mean, and that's what it does mean for our made-up company here, what's the chance of defaulting? And it will usually be within a time frame. Now, the further we go into the future, the less we can see. The crystal ball gets hazier and hazier the further we look into the future. We're looking inside a crystal ball here. So there's our crystal ball. And we're looking inside that crystal ball. And the further into the future we look, the hazier it gets. So we might say chance of defaulting within 5 years. So what's the chance of defaulting with an AAA rating within 5 years? And we might come to a very studious thing after taking everything into consideration. We might say it's less than 0.1%. And similarly, we'll go down. I won't do them all. I'll just do the major ones. So let's say we go for BBB. By the time we've got down to there, we might be saying that's less than 1% chance of defaulting within 5 years. And then let's get down to CCC. CCC, the chance of defaulting might be less, within 5 years, might be less than 20%. All depends on your ratings agency. C might be a very hairy less than 100%. And unfortunately, of course, D means it's equal to 100%. You have defaulted. Oh dear. So very sad there. Depends if you're the asset stripping company, I suppose, so whether you're unhappy there. Now, most ratings agencies do tend to anchor around the same rating. They might have all sorts of things here. This one company might say that's a B1 rating, another company might say it's a BU rating. One company says it's a BB rating, but if we take a particular company, so let's go for the MithrilMoney Moonshot company, most agencies, although they've got different codes, will tend to anchor around the same kind of rating. There doesn't tend to be much difference in the ratings, the credit risk, default risk ratings of ratings agencies for a particular organization or a particular bond issue. Now, this typical rating scale I've got here, kind of A down to D rating, which many of you have probably heard on the news if you haven't ever seen this before. It will change for different markets and different commodities, and there'll be kind of jargon scales for a particular marketplace or a particular country or whatever. So I'll just give you a quick example of one of those. So if we look at something like commercial paper, so commercial paper is essentially corporate IOUs, sometimes known as CP, and that doesn't mean Communist Party. So the MithrilMoney Moonshot company will say IOU $1 million, payable in 270 days time, and then you can buy that piece of paper. You'll pay less than $1 million for it, and then you've got a product that you can sell on. That piece of paper you can sell to lots and lots of people, and then in 270 days somebody will present that to the MithrilMoney Moonshot company, and the MithrilMoney Moonshot company will hopefully pay you $1 million, whoever's holding the piece of paper on the last day. Now, what's the chance of you getting that million back? Well, a typical ratings agency thing for that, because it's usually less than a year, which means it's a money market product, which is cash products usually for less than or up to a year. There'll be a much simpler scale. So the MithrilMoney company might say MM1 is the top stuff, MM2, MM3, MM4, MM5, and 1 will be superior, 2 will be satisfactory, 3 will be adequate, 4 will be speculative, and 5 will be defaulted. But again, defaulted might have some value. It might be worth 30% of the IOU's face value. Take them to court and get an asset stripper to take out assets from the company until you've been paid. You'll get about 30 to 40%. It all depends on the particular case. I think that's probably enough then on the twin topics of default risk, aka credit risk. Now, although it's an incredibly important topic, it isn't the most exciting in the world. We will be coming back to it later on, but I think for the moment, I think that's probably enough for now. I'll see you next time.